Morning, welcome to Ainslie News. It's Thursday, 5th of November, and the election continues on. Classic article again today. We're talking about how the money printers continue to go brrrr. While the political result of the US election is still unknown, either way, the end result will be the same in terms of monetary stimulus, and that is more. To date, we in Australia have watched with detached fascination the eye-watering amounts of money printing happening under the disarming name of quantitative easing, or QE by the Fed, Bank of Japan, Europe's Central Bank and Bank of England. China's BPOC has held off to date as their state control mean that they can accommodate support through fiscal controls and debt. Our little central bank that could now be making global headlines with Bloomberg last night running the story of the scale of Aussie QE program seen nearing Feds as buying begins. The Reserve Bank of Australia's new quantitative easing program is set to close in on the Federal Reserve's when measured against the size of the economy, highlighting the scale of its latest stimulus effort. The plan to buy $100 billion or $71.2 billion in bonds over 6 months will kick off with the expected purchase of $2 billion of government debt at maturities of 7 to 10 years at Thursday's auction. Governor Philip Lowe said Tuesday he estimates the RBA balance sheet will have almost tripled once purchases are completed by mid-2021, compared with the position at the start of this year. Sheet expansion. Check out this graph here. RBA balance sheet set to expand to around 27.5% of GDP following our quantitative easing efforts. The report then talks to Westpac Chief Economist Bill Evans' report yesterday, where he sees the RBA going much harder and longer than their initial $100 billion over 6 months foray, having certainly left open the option of further QE. Evans is predicting the RBA will print around $550 billion, which will take us to 27.5% of GDP, up very close to the Fed's 34%. Earlier in the week, the AFR ran the headline, RBA brings pea shooter to a bazooka fight, putting the $100 billion in pure quantum, not as a ratio of GDP context. The simple arithmetic of adding $100 billion of quantitative easing and assuming no other measures gets the prospective balance sheet expansion to more than 20% of GDP. Compare that to the big three central banks, the Fed Reserve, European Central Bank and Bank of Japan, which collectively have expanded their balance sheets to $22 trillion from more than just $14 trillion at the end of February. The Fed has expanded its balance sheet by $3 trillion to $7 trillion since the end of February and now stands at 34% of US GDP. The ECB's balance sheet is about 60% of GDP, while the Bank of Japan, which started down the slippery slope of QE 2 decades ago, has pushed its balance to about 130% of GDP. Say that again, it's pushed its balance to around 130% of their GDP. These large-scale asset purchases have helped nail down yields. US $10 yields are around 0.85%, while Germany and France's are negative. Japan's 10-year bonds yield 3 basis points. Given Australian yields have offered a premium, it's little wonder the Australian dollar has performed strongly against other major currencies. The article went on to conclude, while the RBA's announcement is history-making, the reality is the outcome of the US election and its impact on the US dollar will probably have more sway on the relative value of the Aussie dollar in the short term than the RBA's QE plans. And that's exactly what happened. On the very day of the announcement, the US dollar fell amid the election uncertainty and the AUD surged as the numerator, not exactly to the RBA's plan. The reality is that the RBA will need to extend to remain competitive in the global race to the bottom. The ECB recently indicated they are likely to unleash more QE at their next meeting, and tonight the Bank of England is widely expected to ramp up its QE program as they enter a double-dip recession. Now, at just 0.1%, the RBA have nowhere to go but zero or negative from here on with interest rates. QE is all they have left by choice. Philip Lowe is on record as not wanting to go into negative interest rates, but also acknowledged they may have to. He is watching and referencing as evidence the damage negative rates are unleashing on European banks and is reluctant to do that to ours. And so it seems likely that the money printers at the RBA, with all major central banks around the world, will continue to go brrr and continue to debase that stuff in your wallet and bank we still try to call money. Real money must have intrinsic value by virtue of limited supply. Gold, silver, platinum, and Bitcoin all tick that box. Currency does not. Full stop. Well, thanks for listening to news again, guys, today. We hope you join us tomorrow. Remember ainslieBullion.com.au for all things physical, ainsliewealth.com.au for all things cryptocurrency, and goldsilverstandard.com for our gold standard and silver standard backed cryptocurrencies. Go and check it out if you haven't already. Enjoy your day. We'll catch you tomorrow.